Every day, trillions of dollars move through U.S. stock markets. Prices rise, prices fall, headlines change. Yet behind these numbers lies a deeper system that quietly shapes jobs, wages, investment, and long-term economic growth. Even for Americans who never buy a single stock, market movements can influence financial stability in ways that are rarely explained. To understand the modern economy, we must first understand the role of stock markets within it. Stock markets are not isolated trading floors or abstract financial arenas. They are deeply embedded in the structure of the U.S. economy. Through them, companies raise capital, households build long-term savings, and institutions interpret economic signals. While market headlines often focus on daily fluctuations, the deeper economic functions of stock markets operate over years and decades, quietly influencing growth, productivity, and financial resilience. At its foundation, the stock market is a system of ownership. Publicly traded shares represent claims on a company's future earnings and assets. When investors buy these shares, they are allocating capital based on expectations about productivity, innovation, and economic conditions. Over time, these expectations help determine which companies expand, which industries grow, and how resources are distributed across the economy. One of the stock market's most critical economic roles is capital formation. When companies issue shares, they gain access to funding without taking on debt. This capital supports expansion, research, infrastructure, and employment. In efficient markets, capital tends to flow toward firms perceived as capable of generating sustainable value-shaping productivity and long-term economic growth. Stock markets also influence the economy through household balance sheets. When equity values rise, households with retirement accounts and long-term investments may feel more financially secure. This perceived stability can support consumer spending, which remains a major driver of U.S. economic activity. When markets weaken for extended periods, confidence may decline, even if employment conditions remain stable. Stock prices also act as signals for corporate leadership. Higher valuations can reduce the cost of raising capital and encourage long-term investment, hiring, and innovation. Lower valuations may prompt firms to delay expansion or preserve cash. These responses, multiplied across thousands of companies, can influence employment trends and economic momentum. At this stage, it may appear that stock markets merely reflect economic conditions. But the relationship also works in reverse. Markets can influence credit availability, corporate confidence, and policy expectations, creating feedback loops that amplify both expansion and contraction. This dynamic explains why markets remain central to economic analysis. Equity markets also shape broader financial conditions. Strong markets can support lending, strengthen institutional balance sheets, and reduce perceived systemic risk. Weaker markets may tighten financial conditions, influencing borrowing and investment even without changes in interest rates. These indirect effects play a significant role in economic cycles. In the United States, stock markets have broad reach due to widespread participation through pensions, retirement accounts, and institutional funds. Market performance can influence retirement security, consumer confidence, and long-term financial planning. As a result, equity markets intersect with labor markets, housing demand, and overall economic stability. A common misconception is that stock markets simply measure economic success. In reality, markets reflect expectations about future conditions rather than present realities. Another misunderstanding is that markets benefit only investors, when in practice their signals influence hiring, investment, and credit across the broader economy. Over time, the role of stock markets continues to evolve. Technological change, demographic trends, and shifting monetary environments all influence how markets interact with economic growth. While the core mechanisms remain consistent, Their speed and scale may increase, making economic literacy more important than ever. Stock markets are not detached from economic reality. They are deeply interconnected systems that influence capital allocation, corporate behavior, financial conditions, and long-term growth. While they do not tell the entire economic story, their impact is both measurable and significant, providing essential context for understanding the modern U.S. economy. To continue exploring how financial systems shape economic outcomes, the next video examines how interest rates and central banking interact with markets, another critical layer of the modern economy. To continue exploring how financial systems shape economic outcomes, the next video examines how interest rates and central banking interact with markets, another critical layer of the modern economy.